Hello, everyone. This is Dr. Duru from Ahan Analytics with the market breadth. Okay, we had a very dramatic week as far as the price action was concerned. Let's timestamp this discussion by using Yahoo Finance as of March 28th at 3:10 Pacific. So the headline explanations for what happened today, we had a hot inflation read. As anyone knows who reads my Inflation Watch blog, I am not surprised by any hot inflation data. And of course, we have our ongoing tariff fears that have just been with us for weeks, many weeks at a time. The market has chosen when to care about them. You can see some other individual company headlines in here that were pretty important today. You can always put a pause on the video if you want to check those out. But most important, like I said, we're time stamping this with the hot inflation data and tariffs. And just for context, we had auto tariffs rolled out. I believe that was yesterday. Yes, yesterday. And then April 2nd is this s- supposed day of liberation for the US when reciprocal tariffs will go into place. Obviously, the market is very nervous about this. Okay, let's go on to the S&P 500. Very disappointing week. It started off promising. In my blog post on Monday, I described how this was a very healthy breakout that the S&P 500 had on Monday. It left behind what I call this area of agitation that really defined the core of the bear market. And for those of you again who don't believe in technicals, pictures say 1,000 plus 1,000 plus many more thousands of words. Check out what happened today, this week. So we had this breakout above the 200-day moving average. We even had a marginal confirmation of that, and that's what got me optimistic that the bear market was ending. I mean, again, I have an unconventional definition of bear market, which is when an index or a stock goes below its 200-day moving average. And I do that because by the time, particularly an index gets down to the conventional definition of 20% below, the bear market is essentially over because it's very rare for the indices to lose more than 20% in a particular cycle. Anyway, so this week started off very promising. I even said a bear market ended because the S&P 500 broke out above that 200-day moving average. But guess what held as strong resistance? Look at this purple line that I've drawn on these charts for quite some time. It matches right where the market closed on election day. And you can see here in January on that first post-election, well, actually, it was the second post-election sell-off. It held perfectly as support. It it held for support only briefly in early March, and now it's a resistance point. And why is it a resistance point now? Well, it's because anyone who was buying at these support levels and held, and then suddenly got caught with losses, is so relieved for the index to get back to this level that you get a lot of selling here. Again, I was hopeful that buyers would have enough strength to just push right through this and challenge the 50-day moving average as the stronger resistance. Unfortunately, we had the headlines, the inflation, the tariffs, all of this stuff is just wearing on the market sentiment and psyche. And you have the end result, which is the S&P 500 went back below the 200-day moving average with a 1.1% loss on Wednesday. And, today was the big follow through, essentially a 2% loss. S&P 500 is now well back within its bear market. I won't be overly concerned until or unless this area of agitation is broken down to the downside, is broken to the downside. The only positive that will come from that is hopefully by then we will get true oversold conditions. And I'll show you in a few minutes what I mean by true oversold conditions. All right, let's go to the NASDAQ. The NASDAQ never left its bear market, so its pullback was particularly devastating. You see it came up short, didn't even test 200-day moving average. I was a little hopeful given the breakout above the 20-day moving average, which is this dotted line, but this selling Friday was particularly bad for the NASDAQ, 2.7% loss because it went right to the low, the previous low. And, it's essentially teetering on a continuation. I was talking to a buddy of mine today talking about what are the worst case scenarios. And the NASDAQ, I hate to say, is poised to make a very quick trip down to the 16,000 level. Now he picked up the 16,000 level because that's around where the NASDAQ last bottomed in August. But notice that more importantly, the NASDAQ bottomed right at the 200-day moving average. Again, technicals. You have to pay attention to the technicals. Look at that. Picture perfect test, picture perfect test of 200-day moving average support, and off the NASDAQ went to the races. Why is this 16,080 line important or 70 line important? Well, I'll scan back and show you. This was the former all-time high going all the way back to November 19th of 2021. And I drew this line because it was going to be an important line when the NASDAQ was finally rebounding out of the bear market. And you can see how it did turn out to be an important line several times. I mean, the NASDAQ in early 2024 pivoted around this line before finally breaking out. And again, this line converging with the 200-day moving average was an important test of an important support point. So now I hate to say it, but with the NASDAQ performing so poorly this week, testing the previous low, maybe it'll pause right here at 16,696, but I think this black line is calling out for a fresh test. And again, all I can say is the upside or the positive of such a sell-off is that the market should be so oversold that the buying opportunities should be really good at that point. Okay, and then let's go to small caps. Small caps, of course, if the NASDAQ has a bad day, most likely the small caps are having a bad day. But look, small caps on a relative basis is performing better because it did not test the March low, even though it had a pretty bad day, 2% down. And of course, as I usually do, I went ahead and bought a call option on this extreme move to sell on the next bounce, hopefully to sell on the next bounce. Of course, hanging in the balance for IWM, the ETF of small caps, is this bear market line. This line marks the conventional definition of a bear market, which is 20% below the all-time high. Okay, now I'm sure the VIX must have popped given such a big down day. And yes, indeed, the VIX is up 16%. Now we're back in elevated territory. Elevated means the VIX is 20 or above. Given all of the technical damage I just showed you, I highly suspect the VIX is set to retest its previous high, if not go even higher. So we're essentially in a race now. In my last blog, I said um, the tariff countdown has begun. So we are in a race with April 2nd being I think that's Wednesday. Sorry, I had to do the math in my head. That's Wednesday. So the market gets 2 full trading days to really get antsy and agitated. And then I guess we get the tariff announcement. Who knows what time it'll be? If the market's really doing poorly, maybe we get the announcement in the morning. If the market is back to complacency, maybe the announcement will come later in the day. Who knows? But anyway, we're in a race now between the market sell-off and the technical damage and the next big catalyst, which is the reciprocal tariffs being announced on April 2nd. Okay, I promised to show you what I meant by oversold enough. Let's go to the regular scale, and I'm going to show you my favorite technical indicator, which is the percent of stocks trading above their 50-day moving averages, which is also called I called it also AT50 or above the 50. And it fell down, let's see, 5 percentage points, and it's back to 26%. Again, I was hopeful that this breakout here was going to continue along with the market and maybe get into the 40 and 50% range. Obviously, it did not even come close. In previous videos, I have warned about what can happen on the first attempt to bounce away from oversold conditions, which is the buyers get tired. That happened the last time here, where we had a very deep sell-off, but then a rebound short of oversold conditions, and then the market got closer. So it's very possible that this time around we're going to see continued selling pressure that's going to get us to the technical oversold level, which is 20% of stocks trading above their 50-day moving averages. So this is something to watch for next week. And per my trading rules, I will get much more aggressive in buying once the market or if the market gets to this level or below. Again, read my blog at drduru.com/ 122 and look up the market breadth trading rules to find out more details on that. Now let's take a look at the percentage of stocks trading above their 200-day moving averages, and we see a similar thing. I was hopeful that this breakout would continue. It did not. And now we're back to wondering whether this longer term indicator of health indicator of market breadth is going to retest the lows. These lows are important because MMTH, or I call it AT200 for above the 200, was last this low in late November. All right, so we have a lot at stake. My short-term trading call remains cautiously bullish because we're so close to the oversold conditions. But the technicals around these oversold conditions, as they usually are, looked pretty bad. Two ways about it. Let's take a look now at a few individual stocks and close this thing out. Okay, we had tariffs. I'm going to look at an auto part company. And you can see MGA, Magna International, fell 7%. It was actually on my list of shorts. I didn't get around to trying to short it today, but it's not one to chase to the downside, but it is one to fade on rallies. The tariffs, until proven otherwise on the auto industry, are looking like they're going to cause a lot of damage. And just really quickly, let me show you what happened to GM. GM lost 7.4%, and Ford, I think, did even worse. Let's see, Ford dropped. Oh, no, actually, Ford didn't drop too badly. Okay. But of course, Ford has been performing pretty badly for a while now. So who knows how much more selling pressure is around for Ford anyway. But anyway, going back to this auto parts company, Magna, it fell down this week. It closed at, it's nearing now pandemic lows. That's how badly it's been doing, actually, since the peak in 2021. Interestingly, we had used car companies, or sorry, rental car companies that have significant used fleets actually did really well just for that one day. For instance, Hertz jumped 22.6%, and Avis, oh, sorry, not the car symbol applies to Avis. Avis soared, what was this? 20.5%. I suspect these are moves that need to be faded. So I'm going to watch for whenever market sentiment turns around on these auto tariffs. I suspect all of the gains for things like car and Hertz to fully reverse. Let's look at the other dealers of new cars. You can see CarMax had a decent day, up 2.5%, and Carvana, we had no movement. And of course, Carvana has a different kind of market, a different kind of market perspective anyway. So anyway, so that's the landscape with the cars. Um, what I want to do next is to see some other individual stocks. Let's see. Let's go to the tech land. Frog, which is a software company. It's breaking down below the 200-day moving average. I've written about this company in Seeking Alpha, and I pointed this out because this is one of many stocks I've seen that started off with a great big post-earnings move, but then sold off hard. And so the danger point here is with Frog going below the 200-day moving average, it threatens to continue to sell off even further. So this is a very damaging breakdown. Now, another stock I want to show in the AI bucket is Broadcom. And I pointed this out because I liked this setup here as a buy and bought into Broadcom around here, but it just came to a complete and utter stop. And because of that complete and utter stop, I got nervous, and sure enough, Broadcom reversed and now created a bearish 200-day moving average breakdown. Because of that, I went ahead and took my losses and just bailed out of the stock. What I don't like is now Broadcom is below its open before it reported earnings. So now this tells me that the market's opinion on Broadcom is changing. So keep an eye out on that. Lululemon had a very bad day. Premium retailer is getting discounted again. It fell 14% post earnings. It's below the 200-day moving average, and it is in bearish territory. it of course has had a lot of choppy trading action. So it's hard to know whether to make much of this at all. I mean, you could see Lululemon has basically gone nowhere since what is this? Since May of 2020. So almost 5 years of just choppy trading in a trading range. And then finally, I'm going to go to Delta. And Delta is one I'm following up on because it was the exact wrong news when they guided below expectations. It gave a red flag warning to the retail sector, and it followed the market in the nice rebound, but reality is setting back in, and Delta actually sold off for the last 4 days and conveniently closed right at the lows of March. I, of course, expect that the selling will resume, and who knows, maybe it'll stop here at the lows from August. All right, let's do one last thing, which is to go to Swing Trade Bot. I forgot to check that out first. Swing Trade Bot is my favorite stock scanning tool, and this is why I wanted to show it because this is the most definitive picture I can show that tells us that everything is completely flipped on its head. Because earlier in this week, we actually had all green for all of the trends, and now we're back to all red for all of the trends, and the signals are also bearish. We've had stocks that are now failing at the 20-day moving average resistance. We have stocks falling below the 20-day moving average. And of course, the stocks falling below the 200-day moving average. And I actually will be focusing a lot in my weekend scans on this category because the stocks that are just now falling below the 200-day moving average, either for the first time or even if it's the second time, are in big danger of falling a lot further here. So thanks for checking in. If you have any questions or feedback, you can put them in the comments. Subscribe to this channel if you want additional content or you want to get alerted to this content. Again, I write about technicals and fundamentals on my blog. If you want more details on what I've discussed and other market topics, you can go to drduru.com/122, all letters /blog. Thanks for checking in, and I will see you the next time. Bye bye.